Good morning, ladies and gentlemen, and welcome to the second panel of the day, which is on the post-pandemic, is covered bonds, the post-pandemic critical friend. I'll just make a short announcement before we start. If you've got a question that you'd like to pose at the end of the session, then please type it in the text below the box, and we'll aim to get an answer to you if we have time before the end of the session. I'm joined today by Thomas Cohrs, who is head of a new business line for financial institutions in the capital markets division of Helaba. Hélène Heberlein, who is head of Fitch's covered bond group. Jens Tolckmitt, executive director of the VDP, which is the Association of German Mortgage Banks. Colin Chen, global co-head financial institutions and structured products, and Mike McCormick, who is head of covered bond origination at Credit Suisse. So starting off with the first topic, which is the dynamic pools and payment holidays, and how have covered pools reacted? And I'd like to kick off with the first question with Thomas. Thomas, covered bonds are not securitizations. They've got many built-in protections. They've got, ratings are driven more by what goes on at the issuer level and at the sovereign level. So do we really need to worry about what's going on in the cover pools?
In principle, yes, of course. One should always worry what's going on in cover pools, because there could be serious developments there that may affect the quality of covered bonds at some stage. But given the safeguards that we have in literally any covered bond program that I'm aware of, such as maximum allowable LTVs, asset encumbrance level, mandatory OC, and the like, there would have to be quite a significantly much stronger deterioration in any given cover pool than we've ever seen in recorded covered bond history. Therefore, in practice, no, I don't think we should worry about that to any great degree. There could be, of course, developments in cover pools that might require action in the form of asset replacements by the issuers, higher OCs, loan loss reserves, and other actions that might have an impact on the senior credit ratings of the issuer or the bank backing an issuer in this respect. But that would in any likelihood put the covered bonds as such at risk? No, not really. Might result in some spread adjustments, but in general, this would more depend on what's happening with peer issuers rather than with the given cover pool. So in this context, I'd say we wouldn't have to worry to a great degree.
Okay, and over to Hélène. How have payment holidays and mortgage moratoria varied across different regions and countries? What's your biggest rating concern?
So the payment holidays figures vary between countries, and it depends mostly on whether it was a voluntary scheme proposed by lenders or whether it was a government initiative. Also depends on how easy it was to request a payment holidays for borrowers. So we have varieties of figures. We don't have very good statistics, I must say. Issuers have not, and everyone's interested in those figures. So I would like to take the occasion to ask issuers to provide them more readily, just for putting everyone at peace. Although technically we don't think it's exactly an indicator of risk, the relative level of payment holidays. I'll give you the example of countries where it's quite high, simply because the selection criteria were very, very wide for applying and for obtaining a deferral of mortgage payments. And so we have figures from countries like, so very no payment holidays in countries like South Korea, or very low, like less than 1% in the Netherlands, for instance, to very relatively higher numbers in Italy or in countries like in the UK, where it was easier to obtain them. The reason we don't think it's an absolute indicator of risk is because maybe borrowers who have asked for this, will realize it's not a free gift; it's only a postponement of payments. So actually the levels have been peaking and are coming down, and many are not renewing the payment holidays they've asked for in the beginning. So yes, I think it's it's a topic of interest, but not necessarily a clear indicator of risk at the moment.
At the moment, so we'll just have to wait and see how things develop. In the meantime, Jens, over to you on German residential payment holidays have been extremely low, and I guess there's not much of a concern there. Although on the commercial side, you know, retail businesses and, as we know, hotels have been hard hit. What are your thoughts about this for Pfandbrief issuers? What are they telling you?
Well, so far our banks have been reasonably relaxed about payment holidays in their both in their cover pools and on their balance sheet as a whole. We have done a survey in mid-May, and we are just repeating this survey now. And in mid-May, we had payment deferrals in 1.4% of the overall portfolio for commercial loans, and 1.6% for residential loans, interestingly, so slightly higher. And as it turns out, we don't have the final figures, but as it turns out, at the end of June, there's only a slight increase in home loans to about 2%, and in commercial loans to about 2.3% of the overall portfolio, which I think shows that there is indeed not a really big problem. With regard to cover pools, it has been slightly lower, and the figures seem to be slightly lower than the ones mentioned for the whole balance sheet now at the end of June. And I think this gives a good picture of the situation, and that there is not really a problem both for the bank and the cover pool. And I think there is one reason for that has to be borne in mind. It's the exposure that property financing banks have on their balance sheets and also in the cover pool are different to the exposures that those banks have that do direct corporate lending, because there is a layer in between, and that is the investor in the property. And from what we hear, especially from the commercial lending side, commercial real estate lending side, is that there have been very productive talks from the very beginning with all those investors into the buildings that are then rented out to the companies, and that is one of the reasons why it is kind of subdued what we are currently seeing. There is an expectation that this might rise in 2021, 2022 maybe, depending on how the crisis develops. This is also something that, as you know, Moody's has recently stated in a report. But at the same time, Moody's has said that yes, there are risks, but the strong position of German banks is kind of mitigating that risk. And if you look finally at the property market, so the market for property and how this develops, it's also that there is, in Germany at least, there is a situation where you can still see property prices rising, both in commercial real estate and residential real estate, and therefore also from that side, and also what our colleagues from our research department are telling me, there is not really the expectation that we will have kind of a crash in the property market in Germany. Always provided that this is not hampered by any kind of major crisis going forward, obviously.
Yeah. Over to you, Mike. The problem that we seem to be having at the moment is that there's just not a great deal of transparency. You know, either in terms of what's been, I mean, you know, the ECBC has come out with a new template, an HTT addition to their harmonized transparency template, and few issuers are putting information on that. But at the moment, it does seem there is a lack of transparency in terms of the loans that are affected by payment holidays, and whether indeed how many of those, or the percentage or proportion of loans that are likely to be considered delinquent further down the line. I mean, how long do you reckon it would take to really develop a good picture on what's happening, Mike?
Yeah, well, I mean, from my side, I don't hear a lot of complaints from investors around the level of transparency. I think investors understand that this is a dual recourse structure. There are a number of structural features in place. like liquidity provisioning and over-collateralization that will insulate the product from some of the issues that we could start to experience in the market, which may derive from some of the loans that are now on payment holidays. You mentioned that there is a transparency template that's out there. Obviously, it's an optional tab. A number of issuers have decided to take advantage of that. Some have not. And I think it's there to the extent that investors start to request that more of issuers, and I think more and more people will complete that. I think it's also interesting to see, some issuers have decided to take a further step. In addition to disclosing the payment holidays that are in the pool, they also can provide more detail on structural matters. So, for example, it's good to know what the level of payment holidays are. But it's also good to know how they're classified. For example, for the purposes of the asset coverage test, is a loan that's in forbearance not considered delinquent, or is it considered delinquent? And if it is, are there any haircuts that are applied when you actually look at the credit you give in the regular asset coverage tests? I think, as time moves on, to the extent that there are more concerns from investors, I think having some readily available information in the reports themselves would be very welcome. Some issuers have done that, and for example, even gone to as far as to say when more cash needs to be included in the pool to make up for missed interest payments. Some have not. There's also some very good third-party research that's out there, some of it from Fitch, who we have on the panel today, which goes through different laws and programs to disclose exactly how these loans are treated. But at the end of the day, I think investors also understand that a cover pool is a controlled environment to a certain extent. So what's happening in the cover pool is potentially different than what's happening outside of the cover pool on that bank's balance sheet, and what's happening in the overall market. Because as we know, issuers actively manage those pools, and what's in the cover pool may not be the full picture. So from my standpoint, I think as things goes on, and I don't think we're going to have a better picture about the long-lasting impacts on various mortgage markets until next year. But as things do move on, I think investors are more looking at the macro picture in individual markets to get an understanding, and maybe even looking at the bank credit, because as we know, the bank is the first port of call for recourse in these structures, and I think that's a good place to start.
Thank you. And finally, on to Colin. I mean, what do you think? Do you think the whole payment holiday issue is going to cause a serious problem for issuers, cover bond issuers? I mean, as Mike said, it does seem like they could basically cherry pick the best assets and leave them in the cover pool, and maybe it's more of a concern of what's going on in the overall bank's balance sheet. What's your view on the sort of cover pool performance?
Well, I think it's not going to be a huge issue with respect to the covered bond product. Primarily, as all of my panel members have already mentioned, the protection of the covered bond product, the dual recourse nature, over collateralization, and I think in particular with the jurisdictions that have enforced the asset encumbrance limits, would ensure that all issuers would have sufficient assets to be transferred to the covered pool if necessary, replaced where necessary as well. But I do think, however, that given where most of the global economies, the deterioration in the global economies will be affected, and you will see the effects in all of the asset classes throughout. And as Mike just mentioned, with the institutions' credit quality as a starting point, I think one would just have to keep an eye out on the proportion of their balance sheet assets vis-a-vis the economy, and then take into that the picture of the percentage of those assets that have opted for deferment.
Yeah. Okay, well, that takes us to the end of that section. I want to move on now to regulatory responses in the crisis and the outlook for the longer-term recovery. And sticking with you, Colin, what measures do you think have been most helpful? Maybe we could start with what's been happening in Singapore, because there hasn't been a lot of coverage of what's been going on in Singapore. But from your perspective also globally, which measures have been most hopeful, do you think, for issuers, and why?
I think if I divide the measures, the intervention that the regulators have enforced is the first and foremost a delay in terms of the implementation of the Basel capital rules. As we all know, the most important element of that delay is to allow the banks to continue to support the economy in terms of lending activity. And I think the delay has certainly helped in terms of cost management from the bank's perspective, both in terms of capital requirements. In addition to that, I think many regulators have as well provided what we call cost control measures on institutions, such as dividend deferral, buybacks, etc. And I think that works together to complement ensuring that the bank's ability to continue lending to the real economy remains healthy. And on the bank side, the help that comes with that is also the fact that covered bonds have, in many jurisdictions, are now an eligible repo product. I think more so in Singapore than many of the what I call the global jurisdictions. I think we see that already. I think I think many of the participants will not be as aware that Singapore has also now put together covered bonds as eligible liquidity facility with the central bank. And this came just before the COVID-19 pandemic. So, it was, it's certainly viewed very helpfully and favorably by all the banks in Singapore.
Thank you very much. And the trouble is with a lot of these, as helpful as they are, a lot of these measures are a kind of a double-edged sword, and in some instances they have they've had counterproductive or bad effects, especially for the covered bond market. Mike, what do you think? I mean, in terms of the unintended consequences that have hurt our market, how would you frame that?
Yeah, so I think it's hard to count all the measures that have been taken in recent months to deal with this. We have liquidity, capital relief. There have been various government guarantee schemes that have been put into place, changes to provisioning. I think the common thread across all of these measures is exactly how markets can be weaned off of them. I think we're here to talk about covered bonds, so I think it's more important to focus more specifically on the liquidity provisions that have been out there, whether it's the term funding or it's the purchase plans, which already existed before the pandemic hits, but now have been kind of ramped up to even bigger size to help out. And I'm pretty confident that the covered bond market in the medium to long term can provide a solution for this. We already got a feel for what that would look like last year when the purchase plan slowed down and banks were preparing to replace the term funding that the ECB was providing. That obviously has now taken a step back, but I think we know that it is possible to do, and that covered bonds, as a funding solution, have a prime spot in making that happen. And some of these other things like the government guarantee schemes and what happens to those loans in the long term, also with respect to what happens to the loans that are in payment holidays or how changes to IFRS 9 and other provisioning changes are handled. I think that might be more for the securitization market and the credit market to handle. Obviously, knock-on impacts to bank credit, or things like how the SSA market or governments might be funding these initiatives could have knock-on effects on covered bonds. But I think just focusing on the term liquidity and the purchase plans, the real question is when does it end, and what can covered bonds do to help that?
Yeah. So, I mean, if it does feel to some extent that the covered bond market is being used as a kind of a policy tool and has become so distorted that, as we've seen, issuance prospects this year have been severely curtailed, and I think that's bad news for everyone, really. But if we look further down the line this year, we've got a US election coming up. We've got potential flu season coming up in December and through to February, where potentially a second wave could really come back, and that might unsettle the markets. On the other hand, it does feel like policymakers have got nothing left in the toolbox to fight the crisis. Over to you now, Thomas. Do you think there's any concern there? Do you think policymakers have still got enough dry gunpowder to fire at the markets if things start going wrong again?
Well, we've seen them already put out quite a lot of instruments over the last month or so. But coming back to your original points here, U.S. election uncertainty and the second wave. I mean, the U.S. elections, well, I think the way the current U.S. president has behaved since he got elected for the first time has already provided enough potential disturbances in the market not to worry too much about that. At least I am not. The second coronavirus wave, however, that's a different story, but I'm not afraid of that to arrive because I think we're already pretty much in it. If you look at current developments in Europe, you see infection rates rising all over the place. I heard this morning in the news that Norway is not allowing Germans to cross the border anymore without a 14-day quarantine. That's really pretty tough. So we might be a hotspot for the time being. But so in general, the concern should be about the pandemic as such. I don't think we should be too worried about the market effects here. There will be some influence on markets, but when it comes to real estate and the ways to finance that, jury's still out. I mean, Jens mentioned before that the German market has proven pretty resilient. I've heard figures yesterday being quoted that the residential market has gone up 5% in the second quarter of this year versus last year. That's in the middle of the pandemic when nobody really was expected to buy anything, but prices go up and they keep going up. The individual space requirements when you go into commercial real estate, for example, seem to be higher going forward. People need more space. We in our dealing room need twice the space we need before for the same amount of people, basically. Then again, you have, of course, more people staying at home, which could potentially drive up home prices because they need more space there. If you ever watch the family of 5 hanging around in an area that's normally only used by 2 for a number of months, the love of your family reaches certain limits at some stage. So I think the tools that we need here at the moment are not really market tools to support covered bonds, because I think they're doing just fine, to be honest. I wish we had more issuers coming out to the market, but with the cheap funding available elsewhere, that doesn't seem to be the case for the time being. Governments should probably apply their tools more to provide the infrastructure going forward if we have a pandemic that's lasting longer than the few months people expected originally. So in that respect, I think we are all adjusting. Markets are adjusting. I mean, we do see turnover when there are issues. At the moment, most of the market action seems to be on SSA trades. That will have other potential disturbance effects later. But your original question, should we be concerned as far as covered bonds and real estate markets are concerned? No, I don't think so.
Great news. Okay. What about Brexit? We'll see what happens. Jens, over to you. I mean, are new measures still possible? Do you think if things start, I mean, you know, if things do go pear-shaped, do you think that there's still possible that the more measures would come out? Would they be equally effective?
Well, you know, I think, and I can only add to what Thomas was saying and what Colin was saying regarding the measures taken. I think the obvious choice of measures going forward, and I think they will be effective, is just to prolong the measures that they have taken so far. In Germany, we have a limited time span for these measures, and politics is currently discussing to actually prolong them for a certain period of time. And I think this is the obvious choice with regard to the immediate coronavirus measures. Mm-hmm. Then I think also, and that is a discussion that we are having also with policymakers, is you have to think about a way to exit these measures. If you cannot go on providing money to the real economy. Yeah? You cannot go on stopping insolvency procedures for companies that are actually insolvent indefinitely. And you have to think about ways to get back to normal, but still mitigate the effects of this going back to normal. And I think this is a very important point for policymakers going forward. And then about the role of banks, I think in the longer term perspective, you have to think about how to enable banks to actually do what they are asked to do, provide loans to the real economy, and not only for the next 6 months, but I think for a period of time that will last into 2022 or something like that because of the coronavirus. And in that respect, we think that you should look at regulatory projects like Basel III and also sustainability and assess to what extent these projects are actually hampering the ability of banks to grant loans to the largest extent possible. Now, if you look at Basel, for example, you only have official figures from EBA, and they are a little bit old, but still EBA has estimated the effects of Basel, and EBA has estimated the effects of coronavirus on regulatory capital of banks. And if you add those up, it is quite dramatic. And now you cannot do anything about rating migration and so on in coronavirus, but you can do something about Basel. And maybe you should look at some of the contents of Basel and some of the measures taken in Basel, and think about whether you should reassess to how to implement this into law in order to just give banks the ability to help the real economy to the largest extent possible. Yeah, and then there's one thing in the short term that I would like to add. Obviously, if you prolong the measures on the policy side, you have to make sure that all those measures that are making it easier currently for banks, for example, the moratoria and the rules by EBA, to actually grant loans, they should be in line with the policy measures that they are now deciding upon.
So just moving on now to the next subject area. We're in unknown territory to some extent, and in terms of how ratings are going to eventually evolve, and credits and banks and so forth. And who knows, how long the lockdown will continue, whether it'll come back, and the economic impacts of that could be quite troublesome in the end, especially for government's budget deficits and so forth. But anyway, rating methodologies and regulations have improved a lot, I think, over the last since the last crisis, and certainly from the covered bond perspective. And when you look at exclusion from bail-in and LCR, I mean, Hélène, in your view, do you think that covered bonds are entering this crisis in a much stronger position compared to the global financial crisis 10 years ago, whenever it was, 12 years ago? What's your opinion on how we're entering this crisis versus the last big crisis?
Yes, if you allow, I will go back to the source of our protection, which is a bank credit, right? And I think banks are entering this crisis indeed in a stronger position than they were at the time of the global financial crisis, for a number of reasons. One of them is that obviously because of all of the and Jens was mentioning maybe that it would be time to relax some of those rules, but ultimately the rules about having stronger capitalization of banks mean that they are now entering the crisis from a stronger position than before. So they were positive news on the regulatory front, and also obviously the liquidity which is available to them at the moment means that the lack of liquidity is not an issue for them. So it's mostly asset quality, the problem really. And I think here we are we call it the forbearance fog, because we know we have forbearance measures, but we don't know what will be the impact of them. And it's true for us on the cover pool side, right? So we know those figures about payment holidays, and we don't know exactly how many will turn into arrears or default. We just know it will be higher than what we've than the base case we formed before, and the same applies to our bank colleagues. So yes, so to come back to our own business, so yes, we are making assumption at the moment that we will, borrowers will face a tougher time, and therefore there will be a higher credit risk materializing in the cover pool than what we've expected before. So we change our assumption, if you want, at the bottom of the range. But typically for the higher rating scenarios, so single A and above, so up to AAA, we think so far our they are long-term stresses, right? So that they are robust enough to sustain the effect of the pandemic. So for the time being, we have not adjusted our stresses in those higher rating levels. We have adjusted them for, as I said, for credit risk and also for refinancing cost reasons, so that the more of the market risk element of our analysis, we've adjusted them for single A and lower. So that has happened, in fact. But yes, and to come back on the protection, so the over-collateralization protection of the programs we rate is generally quite strong. So obviously we watch the program very closely, which have no buffer between the level of OC which we rely upon and the break-even for their ratings. But the vast majority, over 80% of the program we rate, the buffer between the level of OC we rely upon in our analysis and the break-even for their rating is more than 25%. So it's quite a strong protection.
Excellent. Jens, was there something you wanted to say?
Yeah, I wanted to add. I was not asking for relaxing existing rules. I was asking not to burden banks with additional rules, and I think that is a very important difference. Basel III is putting a serious strain on banks' capital. Coronavirus potentially as well. Yeah, if the current measures are exited. And if you look at the current situation with the current state of Basel, I think this crisis, as bad as it is in the end the perfect stress test, so to speak. And if banks weather this stress test, then I think there is a good argument for looking at how much more do we actually need. But in the meantime, I just want to stress that politics-wise, there has to be a kind of direct connection between what politicians ask from banks in terms of providing lending to the real economy and what they enable banks to do. That's just what I wanted to say. And that's only about the new measures that are up to being implemented.
Yeah, I think one of the big risks that we're all facing in the covered bond market is the fact that, we're going to see a lot of sovereign issuance coming down the pipeline. And this is potentially going to affect covered bond valuations. I mean, obviously the market's technically very well supported. We all know the numbers there with the ECB buying a huge amount and the market coming net negative issuance this year. I think redemptions are exceeding issuance by 17 billion or something in the second half of this year. Nevertheless, Mike, I mean, how do you think covered bond valuations are going to sort of square up against all this pipeline of sovereign debt that's going to be coming?
I mean, I think already this year we have seen ramped up SSA supply. At the same time, PEP has taken or gone a significant way to addressing that, right? So if you look at the figures in terms of where they're focused, the public sector purchase program is clearly dominated by, or the pandemic emergency purchase plan is clearly dominated by public sector assets, and so that has dampened it. I think the EU funding initiatives that's going to be coming to the fore later this year and early next year has gotten people thinking about what the impact could be on covered bonds. I think especially for bank treasury investors, there's always this tension of how close can covered bond spreads get to the SSA market, given that there's going to be some capital deployed on the covered bond side, and for many sovereign and SSA assets, you have a risk-free element in the valuation. So I think we don't know exactly what the impact's going to be. I think at the very least, it's for now put a floor on covered bond spreads, and we'll have to see how things progress going forward. But as you said, Bill, there's definitely a technical aspect to pricing everything now. Things are very compressed, and investors are looking at where spreads are now and wondering if they reflect the reality of the product and the true relative value. I mean, on that point, and just on the point of liquidity in general, which is naturally a way of determining what fair value of an asset is, I think one thing that has come out of the recent market volatility that we saw during the COVID period has been some of the buybacks that some issuers have undertaken. Some of these have been very formal tender offers that have gone out to the markets. it's also possible for issuers on an informal basis to go out in the market and purchase a limited amount of their securities as well. And I think that's something that I would like to see continue, because I think it's a way of not only kind of passing on some of the advantageous funding that banks are getting from central banks into the market. It can be used during times of stress, like we saw in March and April, when some fund managers might want liquidity and they're not able to necessarily get it from other investors. But it can also be used during periods like we're in now, where there's limited funding needs. Issuers want to stay in the market, and they can reduce their kind of net issuance by going out and doing these types of exercises. So I think that is something that probably will continue, and personally I'd like to see continue going forward.
Yeah, I mean, everything's kind of overvalued, really. There's been so much central bank intervention and so much liquidity around. It's difficult to really see or assess whether markets are indeed pricing risk correctly. It doesn't really feel like they are. Thomas, what's your view on sort of pricing for risk and where sort of covered bonds sit within that? I mean, obviously the market is technically squeezed, but then on the other hand, it's one of the least volatile markets there is. So maybe it's probably to be argued to be a good place to be if volatility returns. What's your view on the squeezed state of every market?
Well, I mean, you're talking to an eternal bull for covered bonds here. So I would have horns if that's possible right now. But no, I mean, Mike just pretty much listed a lot of the points that would apply to your question here. Relative value, fair value, for all that matters, is an important aspect here. If you look at the way the markets have behaved, yes, I mean, the answer to your question, do I believe markets are correctly pricing risk? The answer is no, they're not. But there is one steady buyer in the market that buys at any price according to the program prerogatives, and that cannot leave the market to perform its function. Is that necessarily a bad thing? No. I mean, at the moment, what it does is it provides a steady flow of issues of an asset type that's considered risk-free, that has its advantages. That's why a lot of people are also buying SSA deals that have not bought them before. There are certain regulatory advantages to that as well. And the most important thing is there is no real alternative, because at the moment there are hardly any covered bond issuers coming to the fore. And the few that are coming are regularly finding very, very responsive markets. The only problem here is, of course, that the real money buyers that you normally like to see in that type of transactions tend to remain sidelined for the time being. What they're buying at the moment is stuff that yields a lot more than even SSA deals are giving, and that's mostly corporate stuff. And here the mispricing, I think, is much worse than for anything else, because the tide lifts all boats, and it has lifted a lot of assets that not necessarily deserved any lifting. And I'm not talking about covers here. As I said, I don't want to single out any specific asset class, but I think if you look at the sort of degree of risk that you can possibly buy with SSAs on one end, if you believe that's a risk-free asset, and capital deals or corporate high-yield deals on the other end, it's pretty easy to see which assets have been mostly mispriced for the moment. In that respect, what does it mean for the future of covered bonds versus other asset classes? Well, people, as Mike pointed out quite correctly, will have to reconsider what the effect on the markets will be of another huge issuer appearing in the market very soon, the EU. With the program that they have announced, they're likely to be the biggest issuer for the time being. It's also a funny fact to see that some of the state issuers, like KfW, for example, have taken central bank money, which I thought extremely surprising. But well, why not? If it's cheaper than actually going to the market, even for an SSA issue, that's an interesting aspect of mispricing in the market, I think. But for covered bonds, it means, in my view, it's a golden opportunity for any investor who can get his hands or her hands on any issues that are coming out. Because at some stage, people might wonder what the deluge of SSA issues is going to do to the value of their pensions. And in that respect, it might be a smart idea to sit on assets that have some real basis rather than the promise of taxes being paid.
So moving on to the next section, which is the long-term implications for the role of covered bonds in a world funding itself out of recession. And staying with you, Thomas, you know, for the last 10 years, pretty much it's felt like the market has become less like a market and more like a monetary policy tool, which is detached from real demand and supply. And it also seems that that trend has stepped up as the years have gone by. Do you ever see that trend changing? Do you think it's just going to carry on going down that road, and eventually covered bonds will become some sort of, I dare I say it, agency product? I know it's not an agency product yet, but if it carries on down the same road as it has been for the last 10 years, who knows where it ends? What's your view?
Well, I'm not only a covered bond bull, I'm also a diehard liberal when it comes to markets. And I might have given you some subtle hints about my views on central bank policy over the last few minutes already. Yet, I think it will come to an end. I do see that changing. I hope it'll change during my active market participant time, which is hopefully still a while to go. And I mean, as we've mentioned before, in the sort of run-up to the pandemic, there was the previous program being finished already, and the central banks were beginning tapering out. And that was actually going along rather nicely, I would say. Real money investors were coming back, and the market for covered bonds was looking like it would be normalizing. That has all gone down the bin right now. Nobody has really suffered from that, apart from investment bankers focusing on covered bonds, of course. But in general, the product has performed. It will continue to perform as long as issues come out in the market, even under the assumption that the central banks or other regulatory authorities will continue to make use of that market as a monetary policy tool, as you described it. However, for that, you need to have substance, and there is not enough issuance coming out to make that a worthwhile exercise, which is one of the reasons why the central banks have focused on other asset classes for the time being. And of course, it would be far-fetched to say there may be other political prerogatives involved here that allow central banks to buy a lot of public sector issues, but that's just the case as it is. I still think that this is only going to be a temporary situation. If we manage to get out of this pandemic at some stage, either suddenly with a vaccine or in a prolonged way by just sort of getting used to different ways of doing business, I don't think there's going to be a reason, or at least a good argument for central banks to continue unabatedly the way they have had to act over recent months. So from a political point of view, there's going to have to be a strong impetus to come back to normal markets. However, having said that, these political imperatives may change. That is, of course, something we do not control, and it's very difficult to foresee that. But as I said, with the benefit of the doubt, if the mandates of the central banks remain as they are, and if our belief in free markets continues the way it has been, I'm pretty sure that we get out of this by another round of tapering sometime towards the beginning of next year, or maybe in the summer. That would be my best guess.
Okay, well, let's hope so. In the meantime, we've got the covered bond directive coming down the line, and the regulatory backdrop pretty much for covered bonds has improved. As I said before, with the exemption from bail-in and inclusion, formal inclusion in the LCR. But Jens, can we continue to take this for granted? You know, given that the harmonisation directive implementation is going to go ahead, it seems more and more that covered bonds are getting the seal of official approval. Is that something that you think is going to continue?
Yeah, I wouldn't take anything for granted that is decided politically. Actually, I've learned not to do that in 22 years in my current job. But I think there is an extremely high likelihood that this is going to happen for different reasons. One is market-wise, covered bonds have again proven to be stable and to return to normal for their issuers in a pretty short period of time in this crisis. And regulatory-wise, we have just finished the European project to actually harmonize rules and implement rules that give comfort to European regulators that have also granted the preferential treatment to covered bonds, and therefore I don't see why there should not be a situation where covered bonds are going to be treated in the future as they are treated now. I think I'm pretty optimistic about that, very optimistic, I would say. I think there is one thing that we always have to bear in mind, and that is don't hamper with the product in terms of what can you use the product for? I think there's a perfect sense and perfect argument for using the product for different needs, especially in this situation, or using the technique of the product for different needs. But we always have to make sure that there is a proper delineation between the covered bond as we know it and the one that we are discussing today, and maybe, for example, ESNs as one tool to maybe lead us, in addition to covered bonds, lead us out of the crisis. And as long as this delineation between the two products is observed, I think there is no risk of regulatory worse treatment than we have today.
On the other hand, I mean, it seemed like we were progressing nicely up until the crisis, and the market seemed to be becoming more and more of a global market, if you like. But I feel that to some extent, the TLTRO and all the various other measures that we've seen other central banks take out has made it much more of a domestic market for individual issues. The UK banks are obviously they're going to the Bank of England. The Swedish banks have got the Riksbank there. The ECB's got the TLTRO. I mean, Mike, do you think that we've taken a step back in terms of the globalization of the covered bond market?
In a way, yes. In a way, no. I think Jens just gave a pretty good overview of the directive and how that work is expected to continue. Over the past 10 years, we've seen a real global expansion of covered bond legislation. And I think that is also continuing. And even at the Basel level, we have recognition of the covered bond product for risk weightings, for the first time. So in that sense, the product is definitely becoming more global. I think in the actual market, I think we have taken a step back. If you look maybe 8 to 10 years ago, there was a real sense that the market was truly becoming global in terms of issuance. We were even, and I know maybe it's a bit of an ongoing joke now, but at one point we were thinking about U.S. covered bond legislation. The dollar market was very large, and there was a sense that issuers would be looking to kind of go around the globe to diversify their investor base. That trend is somewhat reversed. I think there are technical reasons for that, like cross-currency swaps being more difficult to undertake for these types of programs. But I think one of the biggest reasons has been that Euro area issuers have just stopped needing to do that as much. There's always, particular cases where, German issuers might want to match fund part of their cover pool in sterling or dollar. But for the most part, you really don't see Euro issuers going anywhere else because they have very effective funding through TLTRO. Spreads are tight because of the purchase programs. And there just hasn't been as much of a need to diversify. You still have Nordic and Canadian and Australian issuers who have, to a certain extent, been keeping other currencies alive. And of course, sterling market, you have a great domestic issuer base. But, now sterling market's been quite quiet because of TFS. I don't think there's been a Swedish issuer in the Euro market now for almost over a year because spreads in their domestic markets are extremely tight thanks to their central banks buying. The Aussie issuers don't seem to be axed to kind of fund as well. So, if we continue to see, and in the response to this crisis, we have seen other central banks doing similar things to what the ECB has done, whether it's term central bank lending or buying covered bonds or using those as collateral. I think that will set us back in terms of seeing more kind of global issuance across borders.
And Colin, over to you. We've seen the Norwegian, Swedish and Canadian central banks and obviously Europe. They've all really made a special effort to provide support for covered bonds. I'm not sure what MAS has done for covered bonds, but what's your hope and aspirations for the Singaporean market?
Well, I think especially during this period and in the period leading up, the MAS has viewed the covered bond pretty favorably in terms of their understanding of the product. As I think all of you are aware, MAS is not overly prescriptive. They do have a certain amount of developmental responsibility pushed to the market. So they've seen how the covered bond product has evolved and how Basel has also recognized it as Mike has mentioned as well. So I think where MES has, I may have mentioned it earlier, is that they have moved towards actually accepting covered bonds as a repo eligible instrument within the central bank facilities in terms of emergency liquidity funding. I guess the next step forward is to actually normalize their repo activity in terms of business as usual. That's in Singapore. I think we see very much in terms of the new jurisdictions, Korea and Japan, you do see them pushing out in terms of diversification. I think quite the contrary. The volumes may not be as large as Europe, but certainly I think the understanding and the acceptance of the benefits of that product in terms of taking the time and expanding the investor base is something that they've been working on as well.
I mean, that takes us to the conclusion of this panel, and when we'll hopefully open up to questions to the audience. But just while we've got a chance between us members of the panel, does anybody have any further points or questions for other panelists? Nothing. Okay. Well, in that case, I'm just going to hand this over to the audience and see if we've got any questions coming from them. Thank you very much.